Dr. Fishbein,
Yes.
now a good time to throw in a question?
Sure, we've got a couple minutes till we start, and you can just call me Don.
Okay. Has there been research done, and are there practical applications for using the difference between the highs and lows during the middle of a day versus the typical ending price for the day? That difference, has there been analysis to see that difference is predictable, or is it purely as random as the stock market itself, the difference between, start of the day, end of the day randomness?
Yeah, there's a fellow named Art Collins, who is a technical analyst, kind of an old school technical analyst, who's written extensively about that. I believe his website is just artcollins.com. And he has numerous systems that work off of the where the closing price falls in relation to the high and the low of the day. So you might check out some of his work. His systems tend to be, they have a profit factor greater than 1, but a win-loss ratio that's pretty close to 50%. So for many people, they're uncomfortable to trade, but they in fact do make money, since the profit factor is, his wins are bigger than his losses, basically. But he's an old school, no nonsense guy, and where most people, including myself, take 30 to 45 minutes to describe their system. I like that his YouTube videos are always under 5 minutes. So you might check him out with regards to that. Is it time to get started, Samantha?
Yep, I could just introduce this real quick and you can get started. Hello, everyone. This is the second session of the T-8 block. This presentation is on stock market predictions using neural networks. And you can start if you like.
All right. Well, thank you all for coming. My first Zoom presentation. We participated in a lot of Zoom meetings, but this is the first time as a presenter. So what we're going to talk about is mostly money. If you're looking for an in-depth analysis of the mathematics behind neural networks, this isn't that talk. This picture just made me laugh. It's kind of a mashup of Tom Cruise and the J.D. Wentworth commercial and an angry little guy. So I've been coming to TCF for a while. That's second from the left is me. Third from the left is Don Liebes. I grew up in New Jersey, within walking distance of the Liebes's home. I live outside of Denver, Colorado now. Quite the stir recently when Men's Health magazine ranked Denver, Colorado as only the second booziest city in the country. Denverites, as you see in this picture, got to work immediately to try to right that wrong. I did read that while general sales tax revenue has fallen 15 to 20% in Denver, alcohol sales tax revenue is up almost 50%. So it's nice to see that stimulus money isn't being wasted on trivial things like food and rent. This is usually the point at financial talks where there's some sort of disclaimer, past results don't predict future performance. This is for educational use only, et cetera, et cetera. I like this XKCD cartoon, and it's just kind of a warning that I know a few of you out in the audience, but I don't know most of you. You don't know me. For all you know, I'm not even Don Fishbein. You should take everything you hear with a grain of salt. And I've been listening to financial presentations since back in the day, where you would send a couple bucks to an address and get a cassette and some Xerox pages in return. And I've heard a lot of nonsense over the years, but I've heard some good points too. So it's up to you to determine the validity of what you hear. This is an email I got recently, not an email, a physical mailing claiming Ms. Kirkland here claimed that she was able to double your money 41 times in 8 months. Now, I'll just point out, I can't see it at the top of my screen, but 2 raised to the 41st power is about 2 trillion. So that doesn't seem like a reasonable claim to me. I mean, if you started with $1, you could have paid for the recent stimulus bill and had some money left over. You have to take things with a grain of salt. These are my objectives today. Very simple. One, to show you that stocks and their derivatives are the place to be for long-term capital growth, that the market can be timed, that the easiest way for the little guy, and I assume we're all little guys, is to use technical analysis and not fundamental analysis, and that you can make small incremental improvements to good systems using neural networks and genetic algorithms. This is one of the most informative graphs I've ever seen. It's in a book called Stocks for the Long Term or something of that sort by Dr. Jeremy Siegel, who's an economist at Penn. This graph is a little old, but in fact, the differences since December 2013 have even grown greater. The stock market is clearly the place to be. Stocks have vastly outperformed bonds, T-bills, gold, and really done a lot better than the dollar, which has lost almost all of its value in the past 200 years. The other thing to note from this graph, now in the past 10 years or so, the real performance of stocks has been over 10%. So this top line would be even steeper. But the thing to notice, or the thing to note, and most people know this, but very small differences in annual return over long periods of time can turn into very large differences in total return. So this is great. You might look at this and say, I'll just put my money in stocks and be done with it. And that's not a bad strategy. This is just a graph showing the small differences in annual return can translate due to the miracle of compounding to large differences over long periods of time. This is Dr. Siegel, a very smart man, and but he says you don't have to be a timer to do well in the market, and he's kind of right. You don't, if you have a very long time frame. Now, if you're my age or older, you do have to be concerned about a few things with the market. People who try to tell you just buy and hold will show you graphs like this, saying, oh, if you miss the 10 best days, the 20 best days, how your return will go down. I think these are not realistic graphs because your chance of being able to miss the best days is about equal to your chance of being able to miss the worst days, and it would all even out in time. So buy and hold is not a bad strategy. In fact, Fidelity did a study recently and determined that their people with the highest return in their accounts were people who were dead, who they hadn't been informed were dead because they didn't trade. A lot of people have no particular plan trading and do a lot worse than buy and hold. The market has dropped more than 50% on 7 occasions in the past 88 years, taking an average of 9 years to recover. What does that look like? Well, this is a graph from a local person here in Colorado, a PhD economist, who looked at what would happen if you invested $1 for 10 years in the market. And you can see, in many cases, your return would be negative. What you want to avoid is being swept away by a market downturn, especially if your investment horizon is fairly short. This is another graph showing that there have been substantial market downturns over the past 130 years, and that they can take quite a bit of time to recover. This is an article in Bloomberg Business Week by Jack Bogle. I think he's the Vanguard guy, saying that you can't beat the market. And I've got to say, he's just flat out wrong. If you hear something over and over enough times, you start to accept it as dogma. And sometimes you have to step back and say, is that really the truth? Or is the wool being pulled over your eyes? Now these guys, Fama and French, are from the University of Chicago School of Economics, with a powerhouse, and major proponents of the so-called efficient market hypothesis. This hypothesis says that everything that's known is already incorporated into the market, and that the next move the market makes is completely random. They made an interesting comment here. The premier anomaly is momentum, because in fact, stocks that are doing well tend to keep doing well, and stocks that are not doing well tend to continue to decline. And they call this an anomaly. Well, in science, we say sometimes anomalies are indications that your theory is just flat wrong. But to call momentum an anomaly strikes me as sort of odd. Like if you're a flat earther, like the flat earth people put out this diagram of what the world really looks like, you might consider things like gravity and orbital mechanics to be an anomaly rather than established fact. Einstein was not speaking specifically about the markets, but he said basically that there's nothing as annoying as a counterexample. You can do all the experiments you want to prove something's correct, but one counterexample can upset the apple cart, if you will. I have used this example ever since I started talking at TCF, which I think was maybe in the year 2000. And this is an old book on my shelf I bought many years ago, and they talk about the 4% swing system. The 4% swing system simply says, you wait, and when the market goes up 4%, you buy, and the market goes down 4%, you sell. That's it. And obviously, it's not a perfect system. If the market were to go up 4%, down 4%, up 4%, down 4%, you'd lose your money 4% at a time, but it works. And the system was originally described in the 70s, the 1970s, and looking forward in the 80s, 90s, the aughts, and the 10s, it has beat the market every decade. Not by much, 1, 2, 3%. But as we showed previously, small differences over time can add up to tremendous changes. Here's another system that's beat the market. This is my own. I have since 2005 either published or emailed by subscription market timing signals. And we've done substantially better than the market with lower drawdowns. These are the averages over the past 16 years. The DIA, which tracks the Dow, 16.8%, the IJR, small cap, 23.8% with a higher drawdown because of volatility, and the SPY, which tracks the S&P 500, 17.1%. The system did particularly well over the past year during the pandemic. It acted a little oddly. Rather than the 2 or 3 round turn trades that it would generate in a year, it has generated only 2 signals since the start of the pandemic. This buy signal, this sell signal, which was almost perfectly timed 2 days after the market decline started, and this buy signal, which was a bit late, but nonetheless has has predicted a rather dramatic upturn. Since the beginning of 2020, the signal is called Delta, up 43% for the cubes, which track the NASDAQ 100. Buy and hold did pretty well during that period, 37% up. And the spiders, much more dramatic results, up almost 45%, where buy and hold was up 16%. So I hope that I've convinced you the stock market is the place to be. Now, how should we look at the stock market? There's two basic schools of market analysis: fundamental analysis, which looks at the fundamental characteristics of stocks, earnings, growth, debt, things of that sort, and technical analysis, which just looks at the price and volume. Now, fundamental analysis might, at first glance, seem to be the way to go. I mean, shouldn't you look at things like what industry a stock is in and whatever? But the problem for the little guy, certainly me, is that you probably don't have the resources to do really good fundamental analysis. Do you want to go head to head with one of Warren Buffett's analysts about railroads and decide which is the best railroad to own? Do you even have access to the same information that Warren Buffett or that a Goldman Sachs analyst has? On the other hand, technical analysis is just based on price and volume. You've got exactly the same information that anyone does. Of course, some forms of analysis don't really fall into any category. I actually sat next to this guy at a financial conference, and he was telling me that at the time he was charging $1,000 a year for subscription to his newsletter and had over 1,000 subscribers. Not too shabby. Not much in the way of results to show. Even fundamental analysis with easier access to information may be declining. This is Buffett's margin of outperformance relative to the S&P 500, and over the years, he's done less. Even had a few years where he underperformed the S&P 500. A brief notice: we had at one hospital I worked at, we had the CEO read an article in the Wall Street Journal saying computers weren't being fully utilized in healthcare. We had a very expensive consultant come in who said that everyone needed dual monitors. That was the way to go. That's the reason we weren't productive. And in my lab, you can see the second monitor here was put to good use. Can you do this yourself? You can. This is a fantastic book. Let me go back for a second. It's out of print, but you can find it on Amazon and eBay. And a couple of statements from the book: the markets are not random, regardless of the large number of academicians who argue the efficient market hypothesis. Yes, thank you. They are simply wrong. Not sure who this guy is. He looks a little familiar. Maybe a governor? I don't know. But the fact is, a lot of people don't make their market decisions based on data and science. They're more random. Technical analysis has many different subcategories. Two basic categories are chart reading and algorithmic trading. And I'm an algorithmic trader. That's what the Delta system is. Charts I find too confusing, too arbitrary. You can decide how these trend lines are drawn. It's, ask 10 people to do it, you'll get 8 different charts. So I'm not a chart reader per se. It just presents too much information from my opinion. Algorithmic trading has these characteristics. It's non-discretionary, meaning that there's no input from you once you decide on the system to follow. And this is important because a system that is discretionary really can't be back-tested. A system that is completely non-discretionary can be back-tested, and I'll speak a little more of that later. Indicators are basically functions of price and volume. For me, mostly price. It involves rules. The systems can be optimized, and most importantly, they can be tested. And if you come from a scientific background and are familiar with the scientific method, you know that testing and proving a hypothesis is very important. Excuse me for a second. So let's look at one of the simplest technical indicators and see what we can do with this. And that's moving average. What a moving average is simply the average of the last n number of bars, a 5-day moving average, a 10-day moving average. You simply sum up the past 5 or 10 and divide by the number n. And what this does is tends to give you a smoothed curve of the price. Now it's technically, I guess, it's a low pass filter. It filters out some of the high frequency noise. The general principle in trading moving averages is that when the price is above a moving average and a shorter term moving average is above a longer term moving average, that's a long signal, a signal to be in the market. Let's look at an example. Is the bull market dead? I think Joe was asking, or somebody was asking at the beginning of the talk, is the bull market dead? And here's a graph. And what we have here are very popular moving averages that you hear all the time on CNBC and MSNBC and shows like that, Fox Business. The candlesticks are the S&P 500 over the past year. And the blue line is a 50-day moving average. And the red line, a 200-day moving average. And these are quoted all the time as though they're gospel. And what you can see is that right now, well, for the past 9 months, the price has mostly been above the 50-day moving average, and the 50-day moving average has been above the 200-day moving average. So those are bullish signals. There's a couple of things you can divine from this graph. One, if you've ever heard of the death cross or the golden cross mentioned on these analyst shows, that's when the 50-day moving average crosses the 200-day. So right now, here's your death cross, and here's your golden cross. One thing we can notice is that these signals are pretty late. Moving averages, because they filter out high frequency components and smooth, have lag. And here you can see the death cross, which is the signal to get out of the market, came this is the bottom of the pandemic decline back in March. And you can see that when this sell signal comes, it's late. The market's already started to rise. So that would be a losing signal. If you sold short here and bought long here, you would have lost money. So they're not the greatest signals. But nonetheless, analysts talk about them like they're the gospel. I heard one guy around here, well, it would have been back here off of the graph, say, well, since price has fallen below the 200-day moving average, we are now in a secular bear market. For some reason, when you talk about markets, secular means long-term. Strange definition. And the fact is that secular bear market lasted 8 days. So moving averages have some validity, but you can see there's lag. And then when the golden cross occurred here, and it was time to get back in the market, well, the market had been going up for 3 months before you got that signal. Anyway, there's a difference in the literature of technical analysis and the literature, say, of medicine. If you get a multi-author, 8-pound medical textbook, when you take the shrink wrap off of it, it's out of date. It's taken 1 to 2 years to compile. The references in the books don't go back or no earlier than 2 or 3 years in the past. They're out of date. But technical analysis, it's great. You can go back to very old articles, pull out a system and see, hey, what's it done for the past 20 years since it was described? Because the danger is always with an article that it's been curve fit to fit the data. So anyway, this is an article, and if you're interested in technical analysis, the only journal I'd recommend is the Technical Analysis of Stocks and Commodities. It's fairly cheap, and the really nice thing is that once you subscribe, you have access to their digital archive, which goes back 20 or over 30 years. I'm not sure when they started publishing. So this is an article that I pulled out, and I'm going to speak a little more about this now. And what they described was a substitute for the moving average. And they call it the moving trend. And it's very simple. The math is down at the bottom, but very simply what it is you take a regression line for some period of time, and you take the current point on the regression line, and then you move forward and you plot those out. And let me go on to the next slide. We can see it a little better here. This is the S&P 500 for the year 2021. And what we can see are the prices are plotted in these open and closed bars. And the blue line is the moving average, is a 5-period moving average. And the orange-red line is a 5-period moving trend. And the magenta line is a 10-period moving trend. And what you can see is that the moving trend tends to track the price more closely, has less lag than the moving averages. Here's an example where the moving average is still moving down here, and the moving trend has turned up as the price has. So I was thinking, looking at this and saying, gee, what if we took a standard technical analysis system, where if price is above moving average, that's a buy. And what if we, instead of the moving average, we put in the moving trend? Would we do any better? So here's an extremely simple system, which I'm going to use for demonstration purposes. I say I'm using it for demonstration purposes. Back when I showed the 4% swing system, now I've used that for 20 years, and a fellow came up to me at a TCF talk. He had been to the one the previous year, and he apparently heard me talk about the 4% swing system, and that's all he heard at the talk, and that's what he thought I was talking about. And that was the system to trade, and he had actually traded it for the past year, and he wanted to show me his results. And I was like, no, that was just to make a point. Anyway, this system is just to make a point, but basically we're going to take a standard moving average system, and we're going to substitute the moving trend for the moving average, and we're going to see, does it do any better? So, this is a sign that always makes me laugh. It's outside the north gate of the United States Air Force Academy in Colorado Springs. The sign actually makes perfect sense, but it certainly gives you a double take. Oh, you can't come in, you're a commercial vehicle, but I've got a bomb in the back. Okay, come right in. Now, in fact, the explosive inspection station is at the north gate. The south gate is the commercial entrance. But I always thought this sign was funny. So here's what we did. We took we used this system trading 5-minute bars from a little over a year. And we did no optimization of any kind. We simply used these rules. So the close has to be greater than the 5-period moving trend, and the 5-period moving trend greater than the 10-period moving trend. And with no optimization, this system beats in both the S&P 500 and the NASDAQ 100, it beats the buy and hold by roughly 2.5%. That's a pretty good result all in itself. To beat the market by 2.5%, a lot of hedge funds don't do that. A lot of advisors don't do that. So that's a pretty good result. And this system is extremely simple, no complicated mathematics of any kind. Incidentally, if you're paying a financial advisor, 0.75% or 1% or 2% a year, you might want to look at back at the compound interest graph and say, gee, do I really want to give up that kind of return over a 30-year period? Anyway, So one question to ask is, what time interval should we trade? And a lot of people are, a lot of people trade daily bars, open and close for the day. This is an outstanding book, I think. I say I think because I read it 3 times and I really don't understand it, by Mandelbrot, the fractal guy, called The Misbehavior of Markets. And the take-home message for me in the book, there was a lot I didn't understand in the book, but the take-home message was that markets are fractal, that if I show you this graph with no labels on the X and Y axis and say, what is this? What period of time am I showing? You have no idea. This could be weekly bars, daily bars, 5-minute bars. In fact, they're 5-minute bars, but you can't tell looking at this just on the nature and the volatility. You can't tell if it's, an intraday chart or a daily chart or a weekly chart. That being the case, unless you have a system that relies on specific features of the open and close, like the Art Collins system that I mentioned earlier to Timothy, unless you have a system that takes like specific characteristics of how the market opens and the fact that a lot of traders go to lunch between 12 and 2 Eastern time. If you have a system like this system that doesn't have any of those dependencies, it should work on any time frame because the nature of the market is pretty much the same, whether you're looking at 5-minute bars or daily bars. So if you can, you might as well trade the shorter term bars because your return is going to be higher because there's more price variation during that time period. What if we wanted to optimize the system? And here's where we talk a little bit about some of these concepts from artificial intelligence. The first I'll talk about is genetic algorithms. And the thing with genetic algorithms tend to try to emulate the process of biological evolution. You express the parameters of a system as genes, if you will, and then you employ techniques such as gene copying and crossover and extinction to help you optimize the system. What it offers over brute force optimization, and brute force optimization, I'm sure everyone's at some point in their life has written a program with nested loops to do optimization, for I equals 1 to n, for j equals 1 to n, et cetera, et cetera. The problem is that as the number of parameters you're optimizing increases, the time it takes to do brute force optimization rises exponentially. Genetic algorithms are a shortcut to optimization. This is a 3-dimensional graph, which the error rate is the y-axis here. So the lower down we sink into this bowl, the lower our error rate, the more optimized the system is. And genetic algorithms start at multiple random spots, the red being the optimal solution that we're seeking, and in less time than brute force optimization takes, arrive at an optimal solution or close to an optimal solution. I saw an example where the n kings problem is the problem on a chessboard, which is n by n. You need to place n kings so that no king is attacking each other. And this is easy to solve by brute force, but the time it takes is equal to n squared, where genetic algorithms can do this in time that's more related to linear n. Another technique we have are neural networks, and neural networks are ideal if we want to compute the relationship between indicators. Now, in the rules that I laid out, the indicators were very simple. Price is greater than moving trend, but maybe that's not the best way to do it. Maybe there's some nonlinear relationship that would not be obvious to us. And what neural networks excel in are they're able to find these relationships, which are often nonlinear and non-obvious. If each node at the input level here might be something like price or a moving average of a specific length or other indicators such as RSI or MACD. And the knowledge contained in the neural network is contained in the weights between the various nodes. And if we want to solve a nonlinear problem, we need at least one hidden layer. Now, these are deep neural networks that are rarely used in financial prediction because we have a limited amount of data and we don't want to overfit our data. These are more applicable to things like computer vision. And there's a particular model called feed-forward backpropagation neural network where the math has been worked out pretty well, and there's a iterative system for determining the optimal weights. Now, one thing we have to be very, very careful. I mean, neural networks first came on the scene in the 70s, I believe, and they were seized upon by financial analysts. And the dangers of overfitting were not that well understood. And so they came up with systems that looked great when they were trained on the in-sample data, the data they already had, but when applied to data that the neural network hadn't seen yet, which of course is what you want to do in financial predictions, they failed miserably. And the reason was that the neural network had not learned to generalize. It had simply memorized the inputs, and given an input in the training set, it could very easily cough up the answer. But when it was shown data that it hadn't seen, they did quite poorly. So one way to avoid doing that is called walk-forward testing. And what we do, in this example, we would start here. We would train the network on this data and then let it predict data it hadn't seen yet, week 5. And if that worked, we might go on to the next week, and now we would train it on weeks 2 to 5 and let it predict week 6. And we're walking forward doing this, and we have, in this case, we have 8 tests of out-of-sample data. And if we have a good return, and these are all data the system hasn't seen yet, and if it does well walking forward, we can say, well, we might have something here. Now, there's a step beyond this. I mean, one of the problems we always have with financial data is we don't have enough data. We might have 10, 20 years of a stock, but that's not a lot of sample points. You know, it's not the millions of sample points we'd like to have. There's another system I'm not going to speak about in any detail called Monte Carlo testing, where we generate sample sets that look like the original data, but are not the original data. And then we can test it on thousands of sample sets. This particular system, since I only put this talk together a few days ago, I haven't had the time to do Monte Carlo testing, particularly when neural networks and genetic algorithms are involved, is very time consuming, can take weeks of processing time. So I don't have that here, but realize there is a even more rigorous system of testing these. I thought this was hysterical. Like I pay, therefore I am. You know, some Descartesian philosopher must have made up this sign, or it could have just been a printing error. So how can we use the two together? Well, what we can do, neural networks are trained in stages, in iterations. We train it and we look for the error in predicting the out-of-sample data to slowly decline in time. What we can do, if we have a genetic algorithm available, is with each iteration of the neural network, we can re-optimize the parameters. Genetic algorithms are good for coming up with parameters, and the parameters in the sample I was showing you might be the 5 and 10 day numbers. And those might not, those are just arbitrary numbers. They might not be the best numbers. There might be better numbers to have. So we can iteratively do this. Do one iteration of the neural network, then re-optimize the parameters, another iteration, so forth and so on. And over time, over many, billions of computer cycles, we can arrive at the best combination of neural network architecture and best inputs and parameters. And the genetic algorithm might even say, you know, that input you have, that's not even a good input. That's just throwing things off. We do better if we exclude that. So that might even be the result. So if we do all that, what happens? Up top, here we have the results I've already shown you, the unoptimized results for the moving trend system, we'll call it. Down here, if we apply 5 walk forwards to our out of sample testing, and we optimize using neural networks and genetic algorithms, we have a fairly significant increase in the annualized return, a small increase in the drawdown. Incidentally, to me, the most important characteristics of a system are the annualized return and the drawdown. The annualized return tells you whether the system is worth trading or not. If the annualized return is less than buy and hold, not worth the effort. But the drawdown tells you if the system is tradable. If you have two systems, one with a 20% annualized return and a 50% drawdown, and another with an 18% annualized return and a 10% drawdown, to me, the system with the lower drawdown is better because you might actually stick with that system. Very few people are going to stick with a mechanical system that has a very large drawdown. I've seen systems with as high as 90% drawdowns. You've got to have nerves of steel to stick with a system like that. And you have no way of knowing at that point whether it's heading to zero or whether it's actually going to show a good return. So this is a brief example, a very simple system. And by using by applying neural networks and genetic algorithms, we're able to substantially improve our return. So this talk has gone a little more quickly than I thought it would. So we're nearing the end. These are the, oh, absolutely, question.
On the previous slide.
Mm-hmm.
Could you clarify that fine point on whether a lower drawdown number between the two optimized versus non-optimized is an improvement, or whether the improvement is in the difference between the return and the drawdown for the two systems? The second one has a greater difference. The first one has not as much difference, but it's got a lower drawdown.
Right. It's frequently a trade-off. And I would say here that the trade-off was certainly worth it. If the second results, do you see my cursor when I move it around? Okay. If, say, we had double the return, but 4 times the drawdown, I would say, I don't know. I'm not sure I'd want to trade that system. But these are pretty close, and I wouldn't be concerned at all about that. Realize that going back to a much earlier slide, I showed that the buy and hold market has 50% drawdowns. So I think you're doing pretty well here, and I wouldn't be concerned at that difference, particularly at these levels. Does that answer your question? Okay. So going back to the objectives and summing up, I think the Siegel graph clearly showed that stocks are the place to be. That you can clearly time the market. I showed both the 4% swing system and the delta record. Number three is, I guess, a little harder to prove because some people do extremely well with fundamental analysis. Peter Lynch was probably the greatest stock picker ever with the Magellan Fund, was a fundamental analyst and did extremely well. I think Buffett shows that as you get into the tens of billions of dollars, it becomes more difficult because it's difficult to acquire large positions in a company. But I'm convinced of number three. I'll acknowledge that it may be difficult to convince everyone. I know some years back I was giving a talk at TCF, and the next speaker came in and started to set up and just launched into a soliloquy about why fundamental analysis was better. And what can I say? They both have their beliefs, but for me, technical analysis is the way to go. And then I can show over and over that a good system can be made a little better or a lot better using some biologically derived mathematical techniques such as neural networks. Neural networks are based on the architecture of the brain, and genetic algorithms are based on the process of evolution. If you're interested in the Delta system, the website nquant.com has subscription information. If you email me either at Don, D-O-N-N, at nquant.com or any address that's on the nquant site, I would offer $100 a year discount on the subscription rate. All I can say is exercise caution. I mean, this is a lightly regulated market, and there are many, many people who do not beat, buy, and hold, and yet sell systems for, $500, $1,000, or several $1,000s, or even more. I've seen all kinds of things. So be very careful what you're buying. If you're starting off with a new system, paper trade it. Almost every brokerage offers paper trading, where you're just trading theoretical money. Be extremely careful. Well, the fat lady has sung, and we're at the end. Be happy to take any questions. I have to say it's a little more difficult giving this via Zoom because it's hard to judge the reaction of the audience. But anyway, I thank everyone for attending. We've got a fair amount of time left, so I'll be happy to take any questions or discussion.
Yeah, Don, this is Joe.
Hey, Joe.
I've known Don for a long time, and I got to tell you, the system's great. It's, I've had, the only problem I've had is convincing various Chase money manager I have to work on these signals, and so which forced me to set up my own accounts over 10 years ago. So all I can say is, be skeptical, do everything on paper first, as Don said, but I'm telling you, this system does work, and it's, as Don said, it doesn't work if you try any kind of individual stock monitoring and trending. But when you look at QQQQ, if you look at Qs, then you can look at an index fund, and it is subject to analysis. Hey, that's my 2 cents.
Well, I appreciate that, Joe. Yes.
Thank you. I just wanted to ask you to clarify the 4% system in quotes that you referenced.
Yes.
I didn't quite follow whether that was
Oh.
just an algorithmic form of rebalancing whenever things get 4% out of balance.
No, it doesn't involve rebalancing. This would be traded on, I think it was originally described on the value line index, which is an arithmetic weighted index of all listed stocks in the US, but it works for S&P 500, the NASDAQ 100. And it simply says that when the market goes up 4%, you buy into the market. And when it goes down 4%, you either go to cash or you short the market. And that's it. I mean, it's utter simplicity. You don't even need a computer to trade it. You can do it with a graph paper and a finely demarcated ruler. And in fact, back in the 70s, a lot of people didn't have trading computers or access to data or anything like that. So maybe it was actually originally done, but it's simply a long cash or long short system. It does not involve any kind of rebalancing. And it logically makes sense that when the market starts to go up, you climb on board, and when the market starts to go down, you get out. And it's clearly not perfect because you're always going to miss the first 4% of every move. But the main reason for mentioning it was simply as a counterexample to say that you can't time the market. And you can time the market. I mean, if a simple system like that works, and if I mentioned Art Collins, again, artcollins.com, and he's written several books, and he has started publishing a series of almanacs where he looks back 10 or 20 years to systems he describes. And he says, how have the systems done in the past 10 years? And they've done pretty well. I mean, that's a pretty courageous thing to do. You will find very, very few people who have done a look back and looked at their results. I like him. He's very, very plain spoken, and he says his piece and goes home. He doesn't have long drawn out things. Anyway. I've mentioned in the past, I'll just mention this briefly, I've listened to a lot of financial seminars, webinars, lectures, whatever, and I have, I call it the 10-minute rule. And if the person hasn't said something useful in the first 10 minutes, I turn it off. And a lot of people, I mean, 10 minutes, and they're still showing you their yacht and their private jet and their home, and they're talking about how they've risen from the ashes in the past 10 years, and sometimes this goes on for 15 and 20 minutes. And when I have stayed around and listened to those talks, they never have anything useful to say. They're sales pitches. They're trying to sell you, their system for $97 a month or $995 a year or whatever. And there's no useful information there. So I hope I said something useful in the first 10 minutes. Anyway.
Hello there. This is
Yes.
Grace. This is Grace in Sarasota, Florida. And hi. And so I had my money in Vanguard, and when the pandemic happened, I put everything in a money market. Mm-hmm. And it's still in a money market. And so I'm getting ready to sell my house, which is going to give me even more money to be sitting on. Mm-hmm. And I'm looking for a way to, of course, make money. I've been in Vanguard, S&P 500, and also in junk bonds prior to the pandemic, and have done very, very well. So I'm interested. Very nice. Yeah, I'm interested in any way to get my money to start making money.
Well, I'm not a financial advisor. I'm probably not supposed to give individual financial advice. But that being said, I would look at the market again, and I would look at broad market funds, exchange traded funds, and this conceivably could be a risky time. Now, the people ask, for example, with the system I publish, well, I didn't take your entry signal back in, March or April of 2020. What do I do now? And the system really is undefined, midway through. And the technical indicators are saying that the market still has a ways to go. And with the government, just dumping money as fast as it can into the economy, it's hard to believe that the market would turn around. On the other hand, interest rates are going up, and inflation is the big bugaboo for the stock market. What some people recommend is a technique called dollar cost averaging. If you have $100 to invest, you don't invest $100 on day one, you invest $10. You wait a month, you invest another $10. And the thought is that if prices go down, you're averaging your entry over time. And that's fairly standard advice, I would think, for financial advisors. Don't put 100% of your money in on day one. Dollar cost average in. And it's congratulations that you've done well in the market, and I wouldn't abandon it. Not to plug the system that I published, but it did not get back in at the bottom, at the absolute bottom, but it did recommend getting back in when the market had started to recover. And people who subscribe to the system have written to me and said, "Gee, what's the use of your system? You've been on a buy signal for a year." I go, "Well, so is the market." And I mean, if you look at market returns, it's done well. But I suppose the short answer is look at dollar cost averaging, and you may want to work with a financial advisor.
Thank you. And how do I get your system? How do I?
Oh, you can subscribe to it just by going to NQuant, NQUANT. It's on the bottom of every slide.
Yes, I'm on there. Mm-hmm.
Okay, and there should be a subscribe page. If there isn't, I'll have to take it up with our webmaster, who is my son. And but there should be, and you can there's contact information also at nquant.com. So if you have questions or you're unable to subscribe, let me know, and we'll take care of it. My son attended TCF last year, but he had a prolonged gaming session last night, and we're on a mountain time. We're a couple hours earlier, so he didn't make the talk today.
Mr. Fishman, that's all the time. I think we're over.
Oh, I'm so sorry.
Yeah, no, that's I'm just saying that's the last question. So
okay. Thank you all for attending. It's been a different experience, and I appreciate your listening. Thank you.
Thank you.
Thank you. I see the subscribe button.
Okay, and if you send me an email, I'll send you a link where you can save $100.
Yes, I wrote that down. Thank you very much. All righty. Thank you so much.
Bye now. Hmm.